Investing isn't just about passive income, it's about building serious long-term wealth. But here's the problem. The biggest buying opportunities happen when stocks are down, and most investors panic instead of taking advantage. It's funny how everyone rushes to buy stocks when they're expensive, but when great companies go on sale, people hesitate. Right now, 5 major dividend stocks are trading at their lowest prices in a year. In this video, I'll break down why they're down and whether they're safe. I'll show you and John how much return you can get if you invest $10,000 into these stocks. And in the end, I'll show you one cornerstone stock of modern industry, a 52-week low stock that has the potential to turn a $10,000 investment into a $5 million retirement portfolio. But first, what is a 52-week low stock and why does it matter? Well, imagine you're walking through your favorite store and you spot a pair of sneakers you've wanted for months. They were selling for $200, but today, out of nowhere, they've been marked down to $120. Same brand, same quality, just a much better price. You'd probably grab them without thinking twice, right? Well, that's basically what a 52-week low stock is. It's when a stock's price has hit its lowest point in an entire year. Just like those sneakers, the stock could still be high quality, it's just selling at a discount. But here's the catch, not every discount is a good deal. Sometimes stocks hit their 52-week low for a reason. Maybe the company is struggling, losing customers, or buried in debt. That's like finding sneakers on sale, but then realizing they're falling apart. It's not a bargain, just a bad buy. So why does this matter to investors? When a stock price drops, but its dividend remains the same, its yield goes up, meaning you're getting a higher return for every dollar invested. If the company is fundamentally strong, buying at a 52-week low can set you up for serious gains when the stock rebounds. But not all stocks bounce back. The key is understanding why the stock is down. Is it a short-term dip due to market conditions, or is it a sign of deeper problems? So a 52-week low isn't an automatic buy signal, but it's a flashing light that says, hey, this stock might be on sale. Take a closer look. And when you find the right one, that's how smart investors turn temporary dips into long-term wins. Coming up next, I've ranked 5 dividend stocks by value addition from solid picks to the biggest wealth builder at number 1. Starting at number 5, we have Avery Dennison Corp. with the ticker AVY. This might not be a company you think about often, but it plays a huge role in your everyday life. Ever notice the price tags on your clothes, the stickers on food packaging, or those tracking labels on shipments? Yeah, Avery Dennison makes all of them. Their products are everywhere, powering industries like retail, healthcare, and automotive, helping businesses brand, track, and package their goods efficiently. So why is this stock sitting at a 52-week low? Well, the economy has been a bit shaky, and when businesses tighten their budgets, industries that rely on packaging and labeling tend to slow down. That makes investors a little nervous, pushing the stock price down. But here's the thing. Avery Dennison is not some struggling company. It has a solid track record even during tough times. It has a current dividend yield of 1.82%, backed by an average dividend growth rate of 9.92%. To top it off, it has an average annual share price appreciation of 13.87% over the past 10 years. Now, let's look what happens if you actually invest in Avery Dennison. Say you and John each put in $10,000 and reinvest every single dividend along the way. After just 1 year, your investment will be valued at $11,569. Fast forward 10 years and that number grows to $41,878. But the real magic happens long term. By year 20, your investment skyrockets to $167,827. And after 30 years, that one-time investment of $10,000 turns into $652,996, with dividends alone paying you an extra $3,227 per year. Over 3 decades, you walk away with a total profit of $642,996, most of it from pure stock growth, accounting for $609,865, plus $33,131 from reinvested dividends. At number 4, we have Erie Indemnity Company with the ticker symbol ERIE, or Erie, a company that flies under the radar but absolutely shouldn't. It's in the insurance business, handling auto, home, and life insurance policies for millions of customers. Now, insurance might not be the most exciting industry, but here's the thing, it is essential. No matter what's happening in the economy, people still need insurance. Whether times are good or bad, companies like Erie Indemnity continue to bring in steady revenue. So why is this stock sitting at a 52-week low? It's not because the company is struggling. The drop is mostly due to broader market conditions and rising interest rates, which have made investors a bit cautious about insurance companies. But let's be real, insurance isn't going anywhere. The need for coverage will always exist, and financially strong companies like Erie Indemnity tend to bounce back. Even with its stock price down, Erie continues to generate profits, pay dividends, and reward investors who stick with it. It has a current dividend yield of 1.34%, backed by an average dividend growth rate of 7.21%, and it has an even stronger average annual share price appreciation of 16.42% over the past 10 years. Based on these metrics, say John puts in $10,000 and reinvests every dividend along the way. After 1 year, his portfolio will be valued at $11,776. By year 10, that number jumps to $49,404. At year 20, his investment will grow to $232,707. But here's where it gets really exciting. After 30 years, his original $10,000 turns into $1,076,342. That's a total profit of $1,066,342. with $1,055,286 coming from stock growth and $11,056 from reinvested dividends. These returns are impressive, but the best 52-week low stocks are still ahead. And stick around because at the end, I'll show you one game-changing stock that could turn a $10,000 investment into a $5 million retirement portfolio. At number 3, we have Booz Allen Hamilton Holding Corporation with the ticker BAH, a company that's been a major player in the consulting industry for decades. If you're not familiar with Booz Allen, they specialize in technology, cybersecurity, and defense consulting. This company has been a powerhouse in its industry for decades, working closely with major U.S. government agencies like the Department of Defense, FBI, and NASA to provide high-tech solutions. So why is Booz Allen's stock sitting at a 52-week low? Well, it has less to do with the company itself and more to do with market uncertainty. Right now, the defense and technology sectors are under pressure, and some investors are nervous about how government budgets will affect companies like Booz Allen. But here's the reality: demand for cybersecurity and defense services is only growing. No matter what the economy looks like, the government and major corporations will always need top-tier security, intelligence, and tech solutions. Even though the stock price has dipped, Booz Allen continues to pay out reliable dividends, and its history of increasing those payments makes it even more attractive. Buying at a low point could be a huge opportunity because companies with steady government contracts tend to bounce back strongly. Looking at the numbers, Booz Allen currently offers a 1.58% dividend yield, backed by an impressive 16.85% dividend growth rate. On top of that, its stock has shown an average annual share price appreciation of 15.95% over the past 10 years, a sign of a strong and growing company. Now let's see how this plays out if John or you invest $10,000 in Booz Allen and reinvest the dividends. After 1 year, the investment would grow to $11,753. Fast forward to year 10, and that number skyrockets to $50,572. By year 20, the investment will be valued at $259,125. Give it 10 more years, and after 30 years, that original $10,000 turns into $1,346,879, with annual dividend payouts reaching $23,386 per year. Over 3 decades, the total profit hits $1,336,879, with $1,190,938 coming from share price growth and $145,941 from reinvested dividends. At number 2, we have UFP Industries with the ticker UFPI. UFP Industries is in the lumber and building materials business, supplying wood and other materials to the construction, packaging, and industrial sectors. If you've seen a house being built, a backyard deck being installed, or even a wooden crate used for shipping, there's a good chance UFP Industries played a role in providing those materials. They serve big retailers like Home Depot and Lowe's, along with construction firms and manufacturers. So why is UFPI's stock sitting at a 52-week low? It all comes down to the housing and construction industries, which have been hit hard by rising interest rates. When borrowing money becomes more expensive, fewer people buy homes, and construction projects slow down. As a result, investors have pulled back from stocks in this sector, pushing UFP Industries' stock price down. But here's why that might be a golden opportunity. Housing markets move in cycles. They slow down, but they always recover. Cities continue to grow, businesses always need new buildings, and demand for construction materials never disappears. UFP Industries is a key supplier in this space, meaning that when the housing market bounces back, its stock is likely to follow. From an investment standpoint, UFP Industries has some seriously impressive numbers. Right now, it offers a 1.13% dividend yield, backed by an incredible 20.57% dividend growth rate. Even more exciting, the stock has shown an average annual share price appreciation of 21.23% over the past decade. That's massive long-term growth potential for investors. Now let's see what happens if you invest $10,000 in UFP Industries and reinvest all the dividends. After just 1 year, your investment will grow to $12,236. By year 10, your investment will be valued at $75,028. At year 20, it reaches $559,695. And after 30 years, that original $10,000 turns into a staggering $4,152,809, paying $31,702 in annual dividends. Your total profit sits at $4,142,809, with $3,963,439 coming from share price growth and $179,371 from reinvested dividends. Finally, at number 1, we have Applied Materials with the ticker AMAT, a company that is essential to the tech world. If you've ever used a smartphone, laptop, or any other electronic device, which is all of us, chances are Applied Materials helped make it possible. They create the equipment and software that chip makers like Intel, TSMC, and Samsung use to manufacture their computer chips. These chips are the brains behind everything from cars and medical devices to artificial intelligence and cloud computing. In short, without Applied Materials, the world's biggest tech companies wouldn't be able to build the chips that power our modern lives. So why is AMAT's stock sitting at a 52-week low? Well, again, it's not because the company is struggling. The entire semiconductor industry has been hit by supply chain disruptions, economic slowdowns, and market uncertainty. That has made investors cautious, pushing stock prices down. But here's what's important. Demand for semiconductors is only increasing. With AI, 5G, and electric vehicles driving massive demand for advanced chips, companies like AMAT are expected to bounce back stronger than ever. That makes its low stock price a potential buying opportunity for long-term investors. From an investment standpoint, AMAT's numbers are seriously impressive. It currently offers a 0.93% dividend yield with a 14.28% dividend growth rate, but the real magic lies in its stock performance over the past 10 years. AMAT has delivered an average annual share price appreciation of 22.68%. Okay, so let's see what happens if you and John invest $10,000 in AMAT and reinvest all the dividends. After 1 year, your investment will be valued at $12,361. In 10 years, your investment will be valued at $81,389. Then comes the big leap. At year 20, your portfolio reaches $642,415. But here's where real wealth building kicks in. After 30 years, your original $10,000 transforms into a staggering $5,006,230. Your total profit sits at $4,996,230, with the majority portion of $4,970,243 coming from share price growth and $25,987 from dividends. Want more in dividends? Click the video on the screen to find out how to earn over $20,000 in monthly dividend income with the same investment amount.